Thank you for joining Money Simplified, your guide to money and mutual funds, presented by Franklin Templeton Mutual Fund. We appreciate your participation. At PersonalFN, we are committed to help investors achieve their financial goals and objectives. Our core proposition is built around unbiased research and financial planning. We wish to thank Franklin Templeton Mutual Fund for partnering with us in this investor education and awareness initiative. Welcome to session 15 of Money Simplified, your guide to money and mutual funds. We are glad to have you with us for our 15th session on modes of investing in mutual funds. So let us begin with our learning session today. In our previous learning session, we learnt about various investment options that you can look at while investing in mutual funds. But do you know mutual funds offer various modes of investing that are designed to fulfill your needs? Yes, even if you are new to mutual funds, it is not necessary to have a big amount for you to start investing in mutual funds. You can start your mutual fund investments with small amount and keep on investing regularly till it steadily grows to a decent amount that may help you meet your financial goals in the future. Let us take them one by one and see how you can invest in mutual funds at your convenience. Moreover, we will also tell you about some features that mutual funds offer that you can use to withdraw your investments as per your needs. So let us start with popular modes of investing in a mutual fund. While mutual funds offer various modes of investing, one should preferably consider his or her convenience while investing in mutual funds. Some of the key modes of investing offered by mutual funds are: number 1, lump sum or one-time investment. If you have a big sum of money, say rupees 1 lakh in your bank account, and are looking to invest it in a mutual fund at one go, then you can consider investing via the lump sum mode. But beware, investing all your money at one time may call for market risk. And so, to reduce this risk, there is an option called Systematic Investment Plan, SIP. SIP can help you invest your money gradually every month or quarter, where you can instruct the mutual fund to buy units of the scheme in your portfolio by debiting a fixed amount from your bank account every month or quarter. But do not forget that the balance money lying in your bank savings account may continue to earn lower rate of return. So what can be a better option to increase returns on your money lying idle? Well, mutual funds offer an opportunity to invest regularly while providing an opportunity to earn better returns on your idle money through the Systematic Transfer Plan, STP. STP is a mode of investing where you can initially park your entire rupees 1 lakh in a less risky category of mutual fund such as a liquid scheme, and then systematically transfer money on regular basis from liquid scheme to an equity fund or any other mutual fund scheme of the same fund house. So while you are able to invest your money on a regular basis, the liquid scheme provides you an opportunity to earn returns better than your bank's savings account. Let us run you through this in more detail. Lump sum or one-time investment. Lump sum mode helps invest all your investable surplus at one go. Even if you have large corpus to invest, you can invest all money in mutual funds through a single transaction. But as we mentioned earlier, lump sum investment attracts market risk, so you need to be careful. You should invest in lump sum only if you have an appetite for high risk, as chances are high that you may see your investments in the negative for some time. Ideally, while investing in lump sum, you should have a longer time horizon, or on a cautious note, if you have a short-term horizon, then you should invest your lump sum money in less risky options like liquid funds. Lump sum investments can be rewarding only if long-term trend of the economy is positive. You see, the impact of the near-term market volatility may fade over time. So we can say that lump sum investments is more suitable if you are ready to take high risk in anticipation of high returns, or are willing to compromise on the returns by parking your entire surplus in low risk options such as liquid funds. Also, as there is a single transaction, you can make your investments via a single check. You need not write multiple checks or fill any additional forms. So say if you have rupees 1 lakh to invest, you can make a lump sum investment by writing a single check of rupees 1 lakh in favor of mutual fund scheme and submit it along with application form. The other mode of investing is popularly known as SIP, Systematic Investment Plan, SIP. SIP is a disciplined mode of investment. SIP helps develop a disciplined investment strategy by spreading your investments over a certain time period. Through SIP, you can invest a fixed amount of money on a regular basis in a mutual fund scheme. You can start an SIP with a lower investment amount. You see, if you make a one-time investment, you may need a minimum amount of rupees 5,000. But by opting for the SIP mode, you can start with an amount as low as rupees 500 per month. So, SIP can help you steadily build a corpus over time. With power of compounding, SIPs can be a smart financial planning tool that may help you create wealth in the long run. SIPs provide you the benefit of rupee cost averaging. Through SIP, you can invest a fixed amount every month, irrespective of the market movements. As the investment happens on a regular basis, you get an opportunity to invest at various market levels. So when the markets fall, you buy more units with the same amount, while if the markets trend higher, you buy less units and simultaneously the value of your existing units grow. So in the long run, your cost of buying is averaged out and your average cost per unit may work out to be lesser than the average price per unit. You can start your SIP with one-time transaction. Along with the check for the first transaction, you need to fill a one-time instruction form called SIP instruction form through ECS or direct debit, which needs to be submitted only once. Post activation of your SIP instruction, the money can be deducted on a regular basis from a bank account and invested in a respective mutual fund scheme. Now let's take an example to see how SIP works. Suppose you have rupees 1.2 lakh in your bank account. You may easily split your investment over a period of 12 months and invest rupees 10,000 per month in a mutual fund scheme through the SIP mode. Say if this was the scenario in the beginning of calendar year 2013, and as can be seen in the table, if you invested this money in equities or in the S&P BSE Sensex over a period of 12 months in calendar year 2013, then with the same amount of money, the investment via the SIP mode would have helped you accumulate more units than your lump sum investment. We can see that the value of your one-time investment of rupees 1,20,000 was in the negative for a while due to the downside market movement, while simultaneously SIPs helped you accumulate more units. As a result of your investments via the SIP, you have delivered returns better than the lump sum investment. However, this is just an example of how SIPs can help you benefit even from the market volatility. It is not necessary that SIPs outperform lump sum investments every time, but they do help you with the disciplined investment and rupee cost averaging that help you steadily create wealth in the long run. The next mode of investing that we would like to explain is the Systematic Transfer Plan, STP. Though less popular, STP is an advanced version of SIP, which functions with a similar objective. So let's see what makes STP different from SIP. Like SIPs, STPs help gradually investing a large corpus in select asset classes like equities. But unlike SIP, in STP the investor initially invests in less risky liquid funds that may offer better returns and over time gradually or systematically transfer a certain amount from the scheme to another scheme, which may be an equity fund from the same fund house. So can we say STP is relatively safer investment method than lump sum investment and may prove to be higher yielding method than SIP investment? As all investment is not invested directly in risky asset class, STP may turn out to be relatively safe investment strategy. Moreover, it also provides you with an opportunity to put the idle money in your bank's savings account. So if used sensibly, STPs can be a smart financial planning tool that can help you utilize your corpus towards meeting your long-term financial goals. STPs provide you with the benefit of rupee cost averaging. Like SIPs, STP2 help you invest on a regular basis at various market levels. So when market falls, you buy more units with the same amount, while if the market trends higher, you buy less units and simultaneously the value of your existing units grow. You can start your STP with a single mandate. So as an investor, you need to give a single mandate to the mutual fund house to periodically and systematically transfer a certain amount from one scheme to another. While you need to draw the check in favor of the initial scheme, you should mention in the STP application form the name of the secondary scheme where you wish to transfer the money along with the amount and the period. The fund house will process the transaction as per your instructions. Now let's see how STP works. If you wish to invest rupees 1.2 lakh lying in a bank account but without putting all your money directly to market risk, you may opt for STP. Through STP, the entire rupees 1.2 lakh can be invested in low risk liquid scheme of the mutual fund house of whose equity scheme you wish to invest in. So here in the table we can see that rupees 1.2 lakh invested in a liquid fund is gradually transferred to an equity fund over a period of 12 months. At the end of 12 months, the rupees 1.2 lakh transferred to the equity fund, which we assume to have grown at the rate of 12%, would appreciate to 1,28,093, while the liquid fund, if it is able to yield 7% per annum, may provide you a gain of rupees 4,026. So through STP, you can gradually transfer a fixed amount each month from a liquid fund to an equity fund at various market levels and over time create a portfolio of equity mutual funds without putting all your money at risk at one point of time. It is noteworthy that the Indian mutual fund industry has never stopped itself from trying or innovating strategies that can fulfill your needs as an investor, may it be while investing your money or withdrawing it to meet your financial goals. So let us now shed some light on few of the other techniques introduced by some of the mutual funds that may be effective while managing your finances. Value Averaging Investment Plan, VIP. Value Averaging Investment Plan is relatively a new method of investing in equity markets through a mutual fund. While in SIP, the monthly investment is a fixed amount, in VIP, the monthly investment varies, which is calculated as per the targeted performance. So based on the market movement, VIP aims to invest more when the markets are low and invest less when the markets are high. Therefore, unlike SIP, the amount invested each month is not fixed but varies with market fluctuations. A target investment amount that has to be achieved monthly needs to be set. Based on the target, the value of the subsequent investments will be derived from the difference between the target and the actual value of the investment. Through the flexible investment strategy, VIPs help one to lower the cost of purchase of units more effectively than SIP, as the investor can take benefit of bearish phases in the markets and even enjoy the benefit of power of compounding. As the investment amount may keep varying on a month-on-month basis, VIPs may be suitable for investors who are ready to invest different amounts each month. Only a few mutual fund houses offer this facility to investors. SIP versus VIP in S&P BSE Sensex. Let us take an example of a VIP and see how it works. Say you, as an investor, want to invest rupees 10,000 a month for a certain period of time in the calendar year 2013. If you start with rupees 10,000 in January 2013 and at the end of the first month, as we see, the market discounts and the value of investment becomes rupees 9740. So now you need to invest rupees 10,260, that is 20,000 minus 9,740 to make the investment worth rupees 20,000 over a period of 2 months. Likewise, at the beginning of the 5th month in May 2013, if the value of investment is rupees 44,042, then you need to invest rupees 5,958, that is 50,000 minus 44,042 only to make the amount reach the target amount of rupees 50,000 in 5 months. So at the end of 12 months, you have invested rupees 1,20,000 by adjusting the market returns, but the actual money that is debited from your bank account is rupees 1,13,865. And if we compare the gains on the total investment, then we can see that VIP has managed to offer slightly better returns than SIP. But do not forget that here the comparison between SIP and VIP is made for the same underlying investment or the scheme, and the outcome may be otherwise in actual terms for different schemes based on their performances. The other similar concept is Value Averaging Transfer Plan, VTP. Value Averaging Transfer Plan works on a similar concept while flexibly transferring money from one scheme to another based on the set target. VTP is similar to VIP in terms of the concept of investment. The difference here is that instead of a bank account, the money is transferred from a liquid fund to selected equity fund. Like VIP, VTP too helps one invest by flexibly transferring more money in the scheme when the markets are low and less money when the markets are high. The targeted amount and the returns of the scheme are considered for arriving at the amount of subsequent transfers from liquid fund to equity fund. VTP may not be suitable for novice investors. They should instead consider investing via STP if in the early stage of investing. Then the next concept is Dividend Transfer Plan, DTP. Dividend Transfer Plan as a concept works similar to Dividend Reinvestment Plan, but with a difference in structure. Through DTP, one can choose to reinvest the dividend income either from a debt scheme to an equity scheme or from an equity scheme to a debt scheme. The idea is to move the dividend income to a different asset class. So through DTP, the reinvestment of dividend income can be done in another scheme but from the same fund house. Unlike dividend reinvestment, where the dividend amount gets reinvested in the same scheme, through DTP, the investor can instruct the fund house to reinvest the dividend amount in another scheme of his choice as and when declared. Another less popular but useful concept is Systematic Withdrawal Plan, SWP. Systematic Withdrawal Plan is a smart way to plan for your future needs by withdrawing amounts systematically. SWP helps systematically withdraw an amount of money from the invested mutual fund scheme on a regular basis at predetermined intervals to meet the ongoing expenses of the investor. It can be an effective tool to manage one's regular expenses during retirement phase. The money withdrawn through SWP can be credited to the bank account of the investor as per the instructions of the investor. SWP offers fixed withdrawal as well as appreciation withdrawal facility. Through the fixed withdrawal, you as an investor can specify the amount you wish to withdraw from your investment on monthly or quarterly basis, while under the appreciation withdrawal, you can withdraw the appreciated amount on a monthly or a quarterly basis. SWP can help manage regular expenses without keeping the savings idle. If you withdraw all your investments at one point, then the withdrawn money may lie idle in your bank's savings account. But through SWP, your money can keep on earning better returns by remaining invested while you can meet your regular expenses. So here are the points to remember from today's learning session. Lump sum investments attract market risk and can be rewarding if long-term trend of the economy is positive, and so it is suitable for investors who are ready to take high risk for high returns. Systematic Investment Plan or SIP helps develop disciplined investment strategy, and so it can be an effective tool. Even with small investments, SIPs can help you steadily build wealth over time. Moreover, SIPs provide you with the benefit of rupee cost averaging and compounding. Systematic Transfer Plan, which helps transfer a certain amount from one scheme to another, is a relatively safer investment method than lump sum investment and higher yielding method than SIP investment. Value Averaging Investment Plan helps investors invest more when the markets are low and invest less when the markets are high, which helps lower the cost of purchase of units more effectively than SIP. Like value averaging investment plan, value averaging transfer plan too helps one invest by flexibly transferring more money from one scheme to another when the markets are low and less when the markets are high. Dividend transfer plan can help reinvest the dividend income earned by the investor from one scheme to another of the same fund house. Systematic withdrawal plan (SWP) helps systematically withdraw a fixed amount of money from the scheme on a regular basis to meet the ongoing expenses of the investor without keeping the savings idle. So to end our learning exercise today, we now invite you to test your learning by taking up this simple quiz and win exciting prizes. Thank you for participating. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.